Introduction. Welcome to the section on key candlestick patterns. Candlestick charts are one of the most widely used tools in trading, cherished for their ability to visually represent market trends and price movements in an intuitive format. Each candlestick tells a story of price action during a specific period, and collectively, these patterns reveal much about market psychology and decision-making. In this session, we'll delve into three essential candlestick patterns: Doji, engulfing candles, and hammers. These patterns are powerful indicators for identifying potential reversals or continuations in trends. By mastering these, you'll gain a valuable edge in interpreting price behavior and anticipating market movements. Let's get started. Understanding the basics of candlesticks. Before we explore specific patterns, it's crucial to understand the foundational elements of a candlestick. Each candlestick consists of three main components: the body, the rectangular area between the opening and closing prices. A green or hollow body indicates that the closing price was higher than the opening, suggesting bullish sentiment. A red or filled body indicates that the closing price was lower than the opening, signaling bearish sentiment. The wicks, or shadows, thin lines extending above and below the body. These represent the highest and lowest prices reached during the trading period. The upper wick shows the high price, and the lower wick shows the low price. The importance. Candlestick charts are powerful because they encapsulate price action in a single glance, illustrating the battle between buyers, bulls, and sellers, bears. This visual representation of market psychology helps traders identify who is currently in control and anticipate potential changes. By combining individual candlesticks into patterns, we can identify recurring behaviors in the market. Let's now explore these patterns in depth. Doji. The doji is one of the most important candlestick patterns due to its simplicity and the critical message it conveys: market indecision. What it looks like. A doji forms when the opening and closing price